Yo guys, I hope you're having an amazing day. And in this video, we're going to discuss order blocks. First, we're going to talk about how to find a bullish order block and how to find a bearish order block. After that, we're going to talk about when it's a high probability order block and when there's a low probability order block and when to use them. And then we're going to look at examples and how to best enter on them. When looking for a bearish order block, there's three things you should look for. The first thing is a sweep of a high. So in this move upwards, it's going to sweep this last high. It does it right here. After the sweep of the high, there must be a market structure shift to the downside. It needs to leave with displacement. If you don't know what a market structure shift or displacement is, please check out the video about this on this channel. So market structure shifts to the downside. And what is then the order block? The order block are the up close candles, bearish order block, up close candles that swept the high. So in this move, it swept the high. So the up close candles right here, that's your order block. If you mark it out in time, price will come back to the bearish order block. You can take an entry to the downside right there. Now we know what a bearish order block is. You can do the same to find a bullish order block. It's vice versa. So a sweep of a low, it's right here. Then there's a market structure shift up with displacement, and the bullish order block is in the down close candle that swept the low. So somewhere here are down close candles. Those are order blocks. So if you mark it out in time, you can take an entry inside that order block and take a long from there. One of the most misunderstood concepts about order blocks is when to use them. You have high probability and low probability order blocks. The high probability order blocks are the one with the big beefy candles. And with the high probability order block, you should use the open of the candle as the order block. Right here, with the bullish order block, it's here the open. With the bearish order block, it's open. With a low probability order block, that means you shouldn't trade them. If you trade them, only trade them when you are in a clear trend. And with low probability order block, only trade the wicks. So with the bullish order block, from open again to wick, and here also from the open to the wick. And this is the only time you should use them. An important addition to what we just discussed is when a order block is not valid anymore. It's not valid anymore when price closes with a bullish order block below the mean threshold, so the 50% level, and for a bearish order block when it closes above the mean threshold. When that happens, please make sure that you know price could invalidate this order block and trade accordingly. Now you have an understanding on market structure and how to find order blocks and also when to use order blocks. Let's get down to the charts and look at some examples. In this first example, we're going to take a look at a bullish order block. And as we know, a bullish order block, the first thing is it's going to sweep a low, so sell side liquidity will be taken. After that sweep of the low, it will do a market structure shift with displacement, and the order block is in the move down, so the down closed candles that's creating the low. So it can be one, it can also be multiple, and then we draw it out in time. And what we see most of the time is when price comes back to that order block, it gives a big reaction upwards, and it could be a nice entry model. That said, let's look at this example. So our first rule is sell side liquidity. It takes it with displacement, so that's nice. We see a good sweep of liquidity, and then we see a market structure shift right there. So when we see a market structure shift, we're going to look for a bullish order block, and we know the bullish order block is the down close candles that swept the low. So it's right here. These down close candles, 1, 2, 3, 4 down close candles. It's a high probability order block because it's large candles. We're going to take the open. We're going to draw it out in time. And what we know, we don't want to see price closing below the 50% of the order block, because when it happens, it's most probably invalidated, not respected, and it will just trade right through to the downside. What we want to see right here is price trading to the open of the order block, the red line. It can trade to the mean threshold, the 50% of the order block, but most favor just react from the start of the order block and then move away higher. You see right here, price trades to the order block. It closes a little inside the order block, but far from the mean threshold. And look how price reacts from here. In this next example, we're going to take a look at a bearish order block. Bearish order block, we know it's the same as a bullish order block, but vice versa. So we have a high gets swept, can be a little sweep, can be a big sweep, doesn't matter. After that sweep, there needs to be a change of market structure. And then in the up close candles, there's your order block to let it trade down. So we're going to find a order block right here. Can be one up close candle, can be multiple. And we know when it's a high and a low probability order block. When it's a big beefy candle, it's a high. When it's like a doji, like a little candle, it's a low probability order block. That said, let's look at this example. Right here, we have a buy side liquidity, see a sweep. Then we see a market structure down. And what we do, we look at the up close candle. This one, this is your order block. And what we mark out with the order block, we want to see the open of the order block for the entry. It's your entry model. And when is a bearish order block invalidated? When price closes above the mean threshold, so 50% of the order block. That's it. Let's look how price reacts from the order block. So right here, it touches the order block, but it respects the mean threshold. That's really important. Next candle. This is where most traders get really scared. 8 o'clock, big volume incoming, and it touches as a rejection block. We're going to talk about it in another video. But most important, our rules are still intact because this candle closes below the mean threshold of the order block. The next candle does as well. It trades towards the order block, but respects it with its body. And what happens at 8:30, it's a news driver. It touches the mean threshold again, but closed below, and it's 6 October. I guess it's NFP. Guys, don't trade NFP. This was just a random example I found. Don't trade NFP. Don't be that stupid. But yeah, you know the drill. It's always the same. Okay, so now perhaps you think, okay, I know how to spot them, I know how to find them, but we can just play a game and just find all the order blocks inside a down move. So in this situation, it's Friday, 13 October. We just reached buy side liquidity, and we are expecting a reversal from that liquidity point. So here we're going to spot bearish order blocks, and our target is the new week opening gap. So for a bearish order block, what do we know? We want to sweep of a high for buy side liquidity, and which candle did that was right here. Going to mark it out in time, and it gets disrespected right here. We'll always draw it out in time to see if price reacts from it, because the algo remembers order blocks, guys. So here, this candle, it remembers and it trades down big time. So every time there's a high taken, we know, okay, this is small time frame order block. So what's really important when chasing price, I don't recommend chasing price, but if you want to do, if you know, okay, I missed the big entry here, right here, with the market structure shift, with fair value gap, order blocks, but you want to get an entry, just go hunt for order blocks. So what do we see right there? Is here, it's a swing high, it's buy side liquidity. So we're going to look, okay, which candle did break this high? Is this up close candle right here? And it's a big beat candle, so we're taking the open of the candle. And what we see, does it respect 50% of the order block? No, it doesn't, but it's like 55 or 65% of the order block. So it could be, but we need to see how price reacts from here. And we see a big move downwards from there. So we could anticipate this order block getting respected. Then, okay, it trades down. But we see here another small time frame high being taken. So another buy side liquidity. So which candles take out this high? It's this one. And we need to look at our rules as well. Like this, the order block, the up close candle that sweeps the high. And then bodies must respect 50% of that order block. Well, they do. We don't see a close above the mean thresholds, so it's valid, and we can take an entry from here to take this move down. Yes, you can miss this move. That sucks, but we still know we need to reach this target. It's a high time frame. PD rates, an important level. So when you miss this price, yes, we're going to chase price. Yes, it could come back here, but we're going to look for order blocks because order blocks are really, really important here. So we're going to look for a sweep of a high again. Now, what do we see right here? Sweep of a high, buy side liquidity. Now, which candle does it? It's this one. And we want to mark out the mean threshold, 50%. Well, we don't see after displacement price coming back here. We're going to mark out the open of the order block. And look how price reacts right here from this order block. It's crazy, right? So what happens right here? It's New York lunch. And we know from New York lunch, there's a big chance price could retrace a little before hitting the level in the afternoon PM session. So then we're going to do the same. We're going to wait for a sweep of highs. What we see right here, there's a high swept, but we wait for displacement. So which is the high? This is the high, the last high before some displacement down. Which candle did that? It's right there. Bodies must respect the mean threshold, and they do, and price trades back again. And lastly, before hitting the, so even if it's after lunch, you miss this whole move, you can still do, okay, where does price make a move up, sweeping highs? There's a high swept right here. Which candle did that? This high probability order block, it's big. And look how price responds from this one. So I took this trade as well. My stop loss was above the high because yes, price can trade upward, but price must not trade above it. So entry was right here and the target was here, and you get a nice 3-1 in like 1, 2, 3, 4 in 5 minutes. And now it reached the target. So when it reached the target, I'm flat for the day. I made my profit because somewhere in this order blocks, you can take an entry if you know, okay, buy side liquidity, a high time frame, buy side liquidity is taken. We see displacement. We know price wants to come down back to this new week opening gap. So this is where the trading day ends. In this last example, we're going to talk about when to enter from an order block. So do you enter from the open of the order block or do you want to entry from the mean threshold of the order block. So this example, this is on Thursday, the 5th of October, and we see here buy side liquidity being swept, and we know how does a bearish order block look like. There is a high being swept, then we see displacement down, and in the up close candle that swept the high, we're going to want to enter downwards. With that in mind, we're going to look at the following example. We see here a high being swept. Which candle did that? It's actually 3 candles that do this. It's right here. So this is your order block. So let's mark this out in time. So here we see a high being swept. Then we see displacement down. And now we want to see this. Always mark out the mean threshold of your order block to see when a order block is still respected or not. Price is trading towards the order block. It already traded inside the order block, but it didn't violate the mean threshold. So that's really nice. So now you have 2 options. You can enter right here at the open of the order block. Your stop loss will be at the top of the order block. And your take profit will be low-hanging fruit. We can make a better target. Let's see, like this is a really low-hanging fruit as well. So it depends on your risk reward. I just like the first low to be taken, just a quick in and out. But if you want to trade here, you have a nice 2.4 RR. And here you have a 1.3-ish RR, so that's also fine. I would like to trade this, but if you want to trade this, go ahead. You can also take 50% off and 100% off here. But let's go back to the topic, is where to enter. So you can enter at the open of the order block to get a 2.45 RR. Or what you can do is enter from the mean threshold of the order block. Most times you see a big reaction from mean threshold. And here you can see same stop loss, same target. And now you'll get a 2.45 RR, but a 5.88 RR. So this is a huge difference. And as you can see, price trades to the mean threshold. The body respects the mean threshold. So we know, okay, price wants to trade down and it comes back to our take profit. So again, I would take the trade at 50% off here, 100% off here. It depends on your trading plan, on risk management. But the point I want to make right here is you can choose to only enter from the mean thresholds. Yes, you can get a way higher RR, but keep this in mind, you're going to miss more trades. On more occasions, price will just come to the open of the order block and then move away. Yes, you can get a lower RR, but you get more trades. I favor this setup, but if you are certain about the mean threshold and you're okay with missing occasional trades to get a higher RR, go with this. I hope this video helped you understanding order blocks. You know how to spot a bearish order block, how to spot a bullish order block, how you can see when a order block is high probability and when it's low probability, when to enter, when not, when to use the mean threshold, when you know it's not that anymore. When using these lessons from the order blocks, you can get really amazing entry, guys, and it can help you get funded. It will help you getting more profits, and it will help you not losing. Because, for example, if you see price violating the mean threshold, you can just know, okay, price wants to go back up and not going down. If you like this video, please like and subscribe, and I'll see you in the next one.